Welcome to Upticks with Jake Falcon, founder and CEO of Falcon Wealth Advisors. In this podcast, we help high net worth individuals overcome financial complexities. We do this by enhancing financial literacy and discussing topics in a language free from industry jargon. Join us as we help explain exactly what having a solid financial plan means, as Jake draws from years of experience in helping hundreds of individuals get financially organized and focused on their goals. We hope you find Upticks educational, entertaining, and shareable. Now, on to the show.
Welcome back to the show. This is episode 199, Seizing Opportunity with Joe Ibarra. Joe, thank you for joining me on the show.
You are very welcome. I'm happy to have my debut. I feel like it's been a long time coming. We've been holding out a bit, but looking forward to it.
Yeah, you've been dodging me. I think you've been on Corey's show, probably half a dozen times already?
Yeah, we don't pick sides here, but it appears that I've been choosing one, at least in terms of the podcast, but happy to be here nonetheless, the Jake and Joe show.
That's right, J and J. And for our audience that doesn't know you, maybe you can give a little bit of a quick background as to kind of where you came from, how long you've been on the team, and one of your many roles that you serve at Falcon Wealth Advisors.
Sure, absolutely. I am from Kansas City originally. I went to Roth University here in town. I studied accounting and philosophy. The accounting is the background that I use more so in my role here. But in college, I was on the CPA track, and I started working for a public accounting firm in their tax department as a CPA. However, after not too much time, I realized it was not for me, and made the pivot to finance and financial management. And that's where I found Jake and Falcon Wealth Advisors. And it's been like a coming home party ever since. I've really enjoyed my time here. Corey likes to joke that I am a recovering accountant and that Falcon Wealth Advisors took me in more or less. But I get to use my CPA background in tax planning, obviously, but also in the broader scheme of investments and retirement planning. And here at Falcon, I am a financial planner. As Jake alluded to, I primarily work with Corey and his clients, but of course we operate as an ensemble. So I'm pitching in when necessary with you, Jake, and your clients. And yeah, so I'm in client meetings, helping strategize and form financial plans. And occasionally I hop on a podcast or two.
Yeah, well, thank you, Joe. And how long have you been at Falcon Wealth Advisors now?
Almost 2 years. It'll be 2 years later this this year.
So forgive me. I can't believe you're coming up on your 2-year anniversary. That's great.
Yeah, it's gone fast, which I think is a good thing, means you're having some fun. But yeah, I feel like I've grown and learned quite a bit in a relatively short amount of time. It has gone by fast.
Yeah, well, thank you. Thank you for that background. And we feel like we're lucky to have you. We actually met you through a client, which is awesome. That's a preferred way actually to meet our new team members. You're also a licensed financial advisor. So you serve basically as extensions of myself and Corey. So if a client ever needs to meet one-on-one about a daily financial planning topic that you're familiar with, we're certainly, you're available to do that as well, which I know has been great. And you're married, right?
That's right. In fact, Monday, which is just 2 or 3 days from the time we are recording, is my 1-year anniversary. So talking about time flying, I can't believe the first year has come and gone. But yep, got married last June. Jake, you got to be there and help celebrate. So thanks for that. And yeah, so learned a lot in the first year. I'm sure everyone who's married knows it is a learning curve, and I don't think that learning curve ever really ends.
No, it doesn't.
But it's been a joy. Absolutely.
Good. Well, congrats. Do you guys have anything planned?
That's a great question. We the months of May and June are packed with lots of birthdays and anniversaries. So we have some plans on Sunday to kind of go back in time, so to speak, and go back to some of the places and moments we had just 1 year ago. So we're going to celebrate by having the topper of our cake and going back to the church and place where we had our wedding and reception. So we're going to go back in time.
Yeah, good idea. That's a good idea, actually. And I'm sure that'll be a lot of fun. So again, thank you for sharing all that, Joe. And And moving on to today's topic, we want to talk about seizing opportunity. And many of our viewers or our audience might be wondering what the heck we're talking about. Well, we see this current market correction, the pullback. The S&P 500 is down, around 10% plus year to date. We see that actually as an opportunity. And some people might say, Jake, you're crazy. How can a negative year be an opportunity? Well, there actually is a lot of opportunity. And today, Joe, you and I wanted to talk about it. But before we go into that, again, I want to give a quick plug. If you haven't already subscribed or followed my show, thank you for tuning in today, but be sure to subscribe on YouTube or your favorite podcast platform. My business partner, like we've mentioned, Corey Bittner, also has his own show called In the Money Insight. Sits right here on YouTube on the same channel. And then it's out there as well on your favorite podcast platform. I'm very humbled. We're getting a ton of downloads every week. I feel like that continues to grow. It's also out there on LinkedIn if you want to subscribe. I send it out weekly on LinkedIn as well. So it's also a blog format. So if you're not into listening or viewing every week, you can certainly read it as well. So we've got 3 different ways to consume our content. And our big deal is that we want to educate clients so they can understand what their financial plan means to them. That's really what we're here to do and the point of Upticks and all of the content that we crank out. So Joe, let's dive right into it. So what are some of, let's just kick off. I know we've got several opportunities that we just wanted to touch on today. Again, a quick disclaimer is it's always going to depend on the individual client situation. So I don't want people watching this show saying, oh, I'm going to go do this because I heard it on a podcast. You always want to meet with your wealth advisor before deploying some of these strategies. And certainly in many cases, you want to sit down with your tax professional, the person that's actually filing your return, and make sure it makes sense. But Joe, why don't you kick us off with our first topic?
Yes, absolutely. And maybe just one quick comment too is
Sure.
I think you make a great point about what are we doing seizing opportunities here. But I think the point is when you have management, when you have full-time management, there's always something you can be doing. There's never a time when we say, oh, we're just going to sit back. So even in downturns, and you can even think maybe more so in downturns, are we actively looking for opportunities? But I think another point to make is we always say, Jake, that we can't time the market, and that's absolutely true. But that doesn't mean there aren't certain times in the market where it's more opportune to do certain things than others. And that's exactly what we're going to talk about today. Why the timing is maybe not perfect, because no one knows if it's perfect, but it might be opportune. And the first, I think, example where that is the case is Roth conversions. And we talk about this a lot. It's a staple of financial planning. And I think the primary reason to look at Roth conversions is more so along the discussion of tax brackets and trying to convert funds in a favorable bracket, or you can even think of it as trying to fill up low tax brackets. But I think an important secondary consideration is converting not just cash, but you can actually convert shares and positions. So in a time like now, when we've had a pullback during the year, converting depreciated stock can be particularly advantageous. When there's a position that has taken a hit, but we still have a positive outlook, it's really helpful to convert those specific shares, because when the potential rebound occurs, that rebound can be tax-free. So it's a great way to optimize. And again, I wouldn't say maybe it's the primary factor. Again, I think that's probably more of a tax-specific discussion, but nevertheless, this is certainly an opportunity. So if it fits into your broader financial plan, into your broader tax picture, I think converting those depreciated shares is really helpful, because again, it creates that rebound effect when depreciated shares come back in a tax-free account.
Yeah, thank you, Joe. That's a really good explanation. And I would say that's one of the most common problems we see in a well-saved retirement plan is that many of our clients, either a Roth IRA was a newer vehicle. So when they were in their careers, they really didn't take advantage of it. And so what happens is many of our clients have $1, $2, $3, $4 million all in an IRA, which is all pre-tax. And what happens is when they turn 72, the IRS forces them to take out approximately 4% of that account. So if you've got $3 million and you're 72 years old, you're going to have to take out $120,000 a year, regardless if you need to pull that money out, and they're going to force you to pay taxes on it, which could start pushing you into a higher bracket later in life. And so these Roth conversions can really mitigate that future tax liability that's inevitably going to come your way if you've got most all of your money in the IRA. And then you bring up a good point. If we bought a stock at 20 and today it's trading at 10, nobody likes that, right? Us included, right? So it's down 50%. What can we do? Well, we can move that stock at $10 a share over to your Roth. Yes, the $10 would be taxable as income to you. But hopefully if it gets back to 20, 30, or 40, all of that growth, Joe, like you mentioned, would be potentially tax-free. Now, we don't just do this by eyeballing it. We would want to look at your 2021 tax return just to kind of see what bracket you were in last year. So it can give us a good idea of what bracket you may or may not be in this year before we can give you advice on that Roth conversion. And so it's a little bit of a process, but again, we've got 4 financial planners on our team. Joe, obviously being one of those, heavy in tax. So we'll just take a look at that return, run our analysis on it, and then give you some guidance on these Roth conversions. Good one, Joe. What's our next one?
Yeah, so I think a similar note, as opposed to putting, let's say, depreciated shares to work, another thing that should be putting to work right now is cash itself. And of course, we talk about this all the time. When the market's low, how can we infuse some cash? How do we, as we say, or everyone says, buy low? And I think whether there's a specific timing in where you are in your financial picture, if there's some type of event in which you happen to have a large cash position, this is the time. And again, we're not timing the market. We don't know for sure, but we can at least say that this would be a more preferable time than, let's say, November or December of last year. So whether it's a large sum that you happen to come into, or it's just kind of the everyday rebalancing of cash that you might have in your account, similar to Roth conversions, this is the opportunity to put that cash to work, because we have to remember that we're not just buying things at a particular price, but we're also buying shares. And when you're buying shares at lower prices, you're buying more shares. And so to think of the long-term investment outlook, the more shares you have, the better. And that's why putting cash to work right now is very helpful.
Yeah, you're absolutely right. And Corey, I think, mentions this a lot, is that stocks are one of the only things that people don't want to buy on sale, right? So it's like, you are basically, the stock market, broadly speaking, is on sale for a 10% discount. And if you know you want to own stocks and you know you want to own them for the long term in your portfolio, why would you buy them when they're 10% above their starting price? Why not buy them when they're on sale at a discount? So you're right. The big issue is, again, we don't know the future. So we got to be very careful on which stocks we buy, and there's no guarantees and all of that. But yes, if you've got cash from an inheritance, or maybe you've just been saving up over the years, or maybe you sold a property, or something happened. Now, probably, if you look long-term, probably wouldn't be the worst time, historically speaking, to buy into the stock market. You certainly wouldn't want to buy it when it's at all-time highs, even though, again, historically speaking, the market has gone up over time. There are no guarantees. Past performance is not a true indicator of the future. All you're getting at here is it's cheaper than it was in December or November. So, and if you know you want to own it, why not buy maybe 50 more shares than you would have been able to buy 6 months ago? So good one, Joe.
Yeah.
Good one. What's next?
This one's a little bit maybe counterintuitive, but similar to Roth conversions in a downtime, something that you can do in a downturn. Tax loss harvesting also falls into that category. Now, this is something we usually evaluate at year end when we know someone's picture with a little bit more clarity. But at the same time, if there aren't those losses to harvest at year end, then it's not helpful. And that's why looking at it right now, when the market has pulled back as it has, is helpful. And in the same way that we usually evaluate Roth conversions at year end, again, it's not as helpful to make those conversions when the stocks aren't as depreciated. Tax loss harvesting is obviously the same way. And that's why right now is a time to take a look and say, are there any opportunities? Are there any unique gains that we're going to have this year that we might look to offset? Are there any positions that we want to move on from? These are the things that we obviously evaluate all the time. But again, right now, most particularly, tax loss harvesting would also fall into that category.
Right, Joe. And you got to be careful though. And you and I talked about this before we started the show today, is that, you don't want to lead with tax loss harvesting, because again, if we think hopefully some of these stocks are going to recover, when you sell a stock, you have to sit out for at least 30 days before you buy back in if you want to buy that exact same stock or something in a similar industry, which is very confusing. So
True.
you have to be careful, because basically by doing that, you're going to be sitting on the sidelines for a month. And everybody, not everybody, but a lot of people that follow the market have noticed we've had some very volatile days. And so you could miss out on that rebound, and it can happen in a matter of weeks. It doesn't take months necessarily. And we saw that back in 2020 when COVID broke out. The market crashed in 30% in 1 month, but it made it all back over just a few months. It didn't take long to get that back. So you wouldn't want to be on the sidelines when that was happening. So you're right. I wanted to bring it up because we have a lot of clients that are going to be forced to sell their company stock and realize a lot of taxes. So if they want to manage some of that tax burden now and not wait until November to December, that is certainly something that we could take a look at. But again, it's very careful. You're playing with fire a little bit. So you want to be very meticulous about what we sell and why we're selling it and what we're going to put that cash in or do with it while we're waiting for this 30-day. It's called a wash sell rule. So you gotta be careful with that. A good one. Thank you for bringing that one up. What's next on our list?
Great. Yeah. So, one of the big headline topics we've had all year is inflation, right? And generally speaking, that's not going to be favorable, at least on a, cash or expense basis. However, when we think about investments, there are some advantages, especially as the Fed raises interest rates. We talked about what that does to the bond side of the portfolio. But an interesting thing that's related is I bonds, the treasury bonds that are inflation adjusted. And obviously when inflation is very high, these are much more favorable. And they have, and you might be able to help me out here, around a 9% interest rate, which sounds very, very good. And I think there are lots of good reasons to look at this. However, I think there are also maybe some things that make it not quite as advantageous. One is you have to hold it for at least 1 year. There's a small penalty. You have to give some of the interest back if you sell it within 5 years. But I think another couple of things are the amount that you can invest in these I bonds is relatively small, $10,000. And I would say the last drawback is we can't do this for clients ourselves. Of course, we can walk you through the process, but it's something that you get directly through the Treasury Direct website. So definitely pros and cons, but in an inflationary environment, even though it's a variable rate, I think taking advantage of these I bonds is a great opportunity. And again, something that isn't relevant all the time. Most people haven't heard about these because we haven't had inflation. So I think that's another thing that in this particular time of the year, inflation's high, I bonds have a good interest rate. It's also something clients should be considering.
Right. And there's a lot of pros with them. Another con probably is it's a little bit complicated for especially some of our older clients. I mean, you literally have to go online and open an account with treasurydirect.gov, I believe is the website. And you want to be careful, right? Because online with cybersecurity and hacking, all that, you want to make sure you're at the right site and you're doing everything correctly. And again, it's great. So you and your spouse, if you're married, you could each put 10,000 in, and it's per calendar year. So if you do it in June, you can turn around and do it again in January. The rate is variable. It resets every 6 months. But like you said, Joe, it's 9% right now. And the US Treasury is backing that rate up, which is pretty solid backing, if you ask me. And so we would be doing it all day long for our clients if we could. Unfortunately, we can't because, again, you buy them directly from the US Treasury. There's something similar to EE bonds, if our listeners are familiar with those. But we definitely, if you've got cash built up that you don't want to put in the market or a traditional bond like we would buy you, definitely should be taking a look at these, especially if you've got more than what you're going to need in the next year. Like I said, it's a good opportunity to get some interest on that money that's just sitting there, literally probably doing nothing still. It's a good one.
Yeah, I think for maybe the last two topics, we can take a bit of a step back. I think we've given some great concrete specific examples, but I think there are two other things we can do in this particular time. And the first is to take a step back and evaluate and even compare what our performance is like. I think in good times, all boats rise, everyone looks good, everyone knows what they're doing in a bull market. I think really where a lot of value is added is in these times when the market has made a pullback. So maybe you can help speak to the fact that in downturns, maybe most especially, is the time that we should really be evaluating, is our strategy working? Do our investment philosophies work well? Are we sticking and being disciplined to the strategy itself? And I think in good times, it's not as easy to evaluate that because things can just be going well because everything is. But I think in downturns especially, these are the times we can take a step back and say, okay, how are we doing? Is it working? And if not, what can we be doing differently?
Yeah, thank you, Joe. That's a good one. And I've been very pleased with the review meetings I've been having with clients lately, because yes, I never like to show a client their account down. That's not a fun conversation, but it is been empowering showing them, hey, Mr. and Mrs. Client, the market's down 13% and you're only down 8, or the S&P is down 13% and your stocks are down 7 or 8, or whatever that comparison is. Now, again, this is a very broad statement, so every client return is different. But for many of our clients, we have been outperforming, anywhere 3 to 5%. And again, I don't want people to take that. I can't officially publicize my returns yet. I think that's coming, actually. We're waiting on our compliance department or the regulators to get that fully vetted. So this is a general statement, but the point of the statement is, if you are working with Falcon Wealth Advisors, I highly encourage you at your next review to ask myself or Corey or Joe, hey, how am I doing compared to the market? And we'll be able to show you that. And so you can compare, saying, hey, if you just slapped your money in the market, this is how much money you would have lost, and this is how much it's down year to date with us. And many clients, that's thousands and thousands and thousands of dollars we have saved them, versus just riding the market. And if you're not working with Falcon Wealth Advisors, I do encourage you to ask your advisor, how am I doing compared to the indexes? Because sadly, for some of our newer clients, we've been doing that comparison for them, and they're down worse than the market. And so that's tough. And we never like to see that, no matter who the client is. But if you're paying somebody to manage your capital and you're a high net worth investor, meaning you've got over $1 million, and they're not trying to protect your downside and they've got you overexposed, I would really encourage you to question that relationship and find out what this advisor is really doing for you. Because for most of our clients, it's about capital preservation and income. They've already made their money. Now they want to live off of it, but they don't want to risk losing it. And of course, there's always going to be risk when you're invested in the market. But if we can make that dip shallower, hopefully that recovery happens that much faster. So that's a good one, Joe. And again, those are just some generic examples of returns. But if you want to look at your returns specifically, certainly get on my calendar or Corey's or Joe's and Matthew's and the rest of our team, and we can certainly walk you through what that looks like. Because I'm proud to actually show that to clients during these times.
Yeah, I mean, that's an easy thing that we can point to and say, here's where we've added real value. And as you said, not just from a percentage standpoint, but also from a emotional preservation standpoint,
Right.
it is valuable to protect that downside. So I think that's really well said. The last thing I wanted to mention, similarly to taking a step back and evaluating what's the performance been, I think just as important is to take a step back and say, how is our plan doing? And we do this for clients every day. Financial planning is, in some sense, at the core of what we do. And I think really financial plans are important here in two ways. One, it's important to remind clients that these plans are built for pullbacks in the market like we've seen. We harp on the fact that we have a target rate of return. And as long as we hit that target in the long term, right? Because anything can happen in, 6 to 12 months. As long as we are hitting that target return in the long term, that is what drives the financial plan. But I think it's also to keep in mind the fact that financial planning isn't a pass or fail exercise. It's not that we say, well, if we don't hit this return, sorry, it's all over.
Right.
Not at all. There is a host of things we can do to optimize, to adjust. And I think a good way to think about retirement planning from a financial planning standpoint is having guardrails. So when the market does pull back, there are adjustments that we can make to improve your plan and to slightly change the trajectory. So again, the 2 points there are, it is important to remember that these plans are built for pullbacks in the market. They're built for adjustments. So there's no need to question the entirety of your financial plan when the market pulls back like it has. But also, I think it's important to remember that there's a host of things that we can utilize. There's a host of decisions we can make to improve a plan that maybe hasn't done as well when the market has pulled back. So I think taking a step back and looking at those two things is really helpful during this time to kind of review and reflect on what's the point of the financial plan and how is it doing.
Yeah, thank you, Joe. That's really good. And actually, a real client story is I had a really good meeting, productive meeting with the client last night, and he made the comment, rightfully so, that literally 0.5% annual return extrapolated out over 30 or 40 years is a major difference in his financial plan. So he was coming from a little bit of an area of concern. He's like, that's crazy that if we have a bad run, that can really impact this thing. So he asked me a really good question, like, what are we doing for that? And I answered it very similar to what you just said, as I told him, look, planning is an ongoing conversation, and it's not going to be right or wrong. Your life's going to change, the market's going to change. And what happens is we see that tail end of the plan, meaning how much money they have in their 90s fluctuating. And if that starts to get to a number extrapolated out again, 30 plus years, where we're not comfortable or he's not comfortable, then we could talk about making adjustments and changes and seeing what we need to do. But that number is, at the end of that plan is going to go up and down every time we meet. It's never going to be the same. Very rare. I mean, I don't think it could be, I guess, technically, but it'd be very rare if that end number was the same every time we met with the client. So sometimes they have 5 million, sometimes they have 4 million. It all factors in. But again, planning is a living, breathing exercise. It's just like your body, for example, right? So it's like, how do I know that my shoulder is going to be fine for the next 30 years? I don't know that, right? Something may happen. You're a tennis guy, right? So something you may tear something or something, and you may have to fix it or change something about your lifestyle. And that's the same thing with financial planning. So again, we're not claiming to predict the future, but we want to say, are we going down the right road? And is the road leading us to ultimately what's important for our clients' financial lives? And if not, let's change it. Let's adapt it. Let's make those adjustments. And so that's important to know. And again, pulling up that plan, I think, has allowed our clients to have confidence during this year, because in many cases, the plan still looks great. And if it doesn't look great, then we have a plan to change it on what we need to do. And so that really should get that confidence boosted back up for our clients, so they don't have to worry about, a client was joking, they talked about it, it's called an economic hurricane and all this stuff that the media is portraying. And yeah, it's not fun. But again, if you revisit that financial plan, your fundamentals, the base, and we take a look at what's going on there and how it looks, that should hopefully help again instill some confidence back into our clients' retirement plans.
Exactly. And I think we can circle back to the main theme really well there. You talked about how financial planning is not a one-time exercise. It's a constant moderation, or we're just constantly looking at it and moderating things. And that's true in financial planning. It's true in investment management. And that's why there's always an opportunity to seize, whether the market's doing well or it's not. And I think that's kind of like the key takeaway from my perspective is when you have full-time management, there's always something you can be looking at. There's always something you could be improving. And that's why we do what we do every day.
Yeah, thank you. I love that. You brought seizing back into the topic, seizing the opportunity. So thank you, Joe. Thank you for joining me on today's conversation. I feel like it was really productive. And again, if you're watching or listening or reading this and you want to set up a time to meet to see if there's any opportunities that we can seize for you, don't hesitate to do that. Get on my schedule, get on Corey's or Joe's or Matthew's or Jake's. Again, we've got a great team, professionals that are happy to meet with you to go over your financial plan and make sure that you understand it and that we're taking advantage of the current environment. So Joe, we're recording this on a Friday morning. It looks like it's going to be sunny this weekend. I know you got anniversary coming up. Any other plans?
Yeah, great question. I actually have one of my best friends from college in town. They are from Omaha and they're down to visit for the weekend. So we're going to spend some time outside, maybe go to World War I Memorial or the Nelson, play some sports, enjoy some good food, and I think take advantage of the beautiful weather that Kansas City has finally gotten. It was brutally hot for a bit and it was cold and rainy. And of course, you just never know. But I think spending time outside, maybe hitting some tennis balls, as you alluded to, is on my agenda for the weekend.
Awesome. Awesome. Good for you. We'll have fun. I'm going to try to squeeze in some golf, as typical for me. If it's not raining and not cold, I'm going to typically try to play around the golf. So, well, good. Well, thank you again for joining me on the show. Thank you for everyone for tuning in. And we hope you have a great week.
Thank you for listening to Upticks. Click the subscribe button to be notified when new episodes become available. Also, be sure to visit our website, falconwealthadvisors.com, and click the Contact Us button if you'd like to meet with Jake and his team.